Hey everyone, welcome back to Corporate Decoder, where we uncover the secrets hidden within those dense corporate filings aka SEC reports, and today we're diving into Launchpad Cadenza Acquisition Corp. As latest report, and let me tell you, this one is all about a big moment for them and the financial moves that came with it. Before we dive in, if you enjoy decoding the financial world and getting straight insights from these documents, hit that subscribe button and make sure to join our Discord community, linked in the description below to keep the conversation going. This report, folks, is essentially a post-game analysis of their successful initial public offering, or IPO. Think of it like a company's coming. Out party on the stock market, they're telling everyone about the big deals they made to get there, the money that came in, and the new people in charge. So, what exactly happened? Launchpad Cadenza Acquisition Corp I, or simply the company as they call themselves here, went public on the 17th of December 2025. This means they started selling their shares to the public for the very first time. They offered a lot of units, 23 million to be exact, and each unit was priced at $10. This brought in a whopping $230 million for the company. Pretty sweet deal to kick things off. Now, what is a unit? It is not just a single share. Think of it as a bundle. Each unit contained one Class A ordinary share, which is like a regular piece of ownership in the company, and 1/3 of a redeemable warrant. What is a warrant? It is like an option giving the holder the right to buy a company's stock at a specific price in the future. In this case, each whole warrant allows you to buy an ordinary share for $11.5. This section lists what they're actually trading on the stock market. You have the units, the Class A ordinary shares themselves, and then those redeemable warrants. All of them are listed on the Nasdaq stock market LLC. This tells us they're aiming for a certain level of transparency and recognition on a major exchange. Here is an interesting little detail. The company is checking the box that says they are an emerging growth company. This basically means they're a smaller, newer company that gets a bit of a break on some of the reporting rules. It is like getting a bit of a head start in the corporate world, allowing them to grow without being immediately burdened by the same strict regulations as much older, larger companies. This part is about all the important contracts they signed to make this IPO happen. It is like the backstage paperwork for their big show. They entered into several agreements, and the filing lists out a bunch of them. We're talking about underwriting agreements, which define the terms of how the shares are sold, warrant agreements to manage those special warrants we talked about, and trust agreements to hold a chunk of the IPO money. One of the key players here is Cantor Fitzgerald and Company acting as the representative for the underwriters. Underwriters are the firms that buy the shares from the company and then sell them to the public. They're essentially the middlemen who help ensure the IPO is successful. This agreement lays out all the nitty-gritty details of that arrangement. Then there is the warrant agreement with Continental Stock Transfer and Trust Company. They are acting as the warrant agent, which means they're the ones who will manage the warrants, handle their exercise, and make sure everything runs smoothly for warrant holders. This is where things get really interesting. They also sold what they call private placement warrants. These aren't sold to the general public but to specific investors, like the sponsor, in this case Launch Sponsor LLC. These private warrants are similar to the public ones but are often part of a deal to get strategic investors on board. This section details those private sales we just touched on. Alongside the IPO, the company sold an additional 4,116,667 of these private placement warrants. These were sold at $1.5 each, bringing in another $6,175,000.5. The sponsor bought a big chunk of these, and Cantor Fitzgerald and Company also picked some up. The key here is that these weren't registered with the SEC in the same way the public shares were, which is allowed under certain exemptions for private sales. Now, let's talk about the people running the show. With a new public company, there are always board and officer changes. On the 17th of December 2025, some new folks were appointed to the board of directors. Sean O'Malley and Jonathan Beer joined the ranks, and Kumar Dandapani and Max Shapiro were also mentioned. It is important to note that Kumar Dandapani, Sean O'Malley, and Jonathan Beer are considered independent directors. This means they don't have any direct financial ties to the company beyond their director compensation, which is good for governance. Jonathan Beer, in particular, has taken on leadership roles on the Audit Committee and the Compensation Committee, which are crucial for overseeing financial reporting and executive pay. The board is structured into 3 classes, meaning not all directors are up for re-election at the same time. This staggered approach is common in public companies to ensure continuity. Jonathan Beer will see his term expire at the first annual meeting, Sean O'Malley at the second, and Max Shapiro and Kumar Dandapani at the third, which typically means they are staggered over a 3-year period. This section covers changes to the company's foundational documents. In connection with the IPO, they filed an amended and restated memorandum and articles of association. Think of this as their updated rulebook. It was made effective on the 17th of December 2025, with the Cayman Islands Registrar of Companies. This just means they've updated their official charter to reflect their new status as a public company. This is where they talk about the money. A massive $230 million from the IPO proceeds, including some underwriter fees, was placed in a trust account. This money is pretty locked down. It won't be released until the company achieves its main goal, which is typically to find and merge with another company. That is what these acquisition companies do. If they don't find a business to combine with within 24 months of the IPO, the money will be returned to the shareholders. It's a way to protect investors' money if the company doesn't execute its primary mission. They also made announcements. On the 17th of December 2025, they issued a press release about the IPO pricing, which is expected, and then another on the 19th of December 2025, announcing the closing of the IPO. These are just formal confirmations to the market that all the big steps have been completed successfully. This is the exhibit list, where they essentially say, here are all the important documents we referenced and filed with this report. It is like a table of contents for all the legal and financial agreements. We see things like the underwriting agreement, warrant agreements, trust agreements, and registration rights agreements. Finally, we have the signature block. This is where the company's leaders officially sign off on the report, confirming that everything stated is accurate to the best of their knowledge. Max Shapiro, the Chief Executive Officer, signed this document on the 19th of December 2025. Alright, let's talk about what this all means. Launchpad Cadenza Acquisition Corp. has successfully navigated its IPO, raising a significant amount of capital. This puts them in a strong position to pursue their acquisition strategy. The fact that they are an emerging growth company gives them some breathing room as they look for their target. The structure with class of shares and redeemable warrants is standard for special purpose acquisition companies, or SPACs, as they're commonly known. The core strategy here is to use the IPO funds to acquire another business. The clock is ticking on that 24-month window, so investors will be watching closely to see what acquisition targets emerge. A key risk is simply not finding a suitable business combination within the allotted timeframe, which would result in the dissolution of the company and return of funds to shareholders. However, the successful IPO itself demonstrates investor confidence in the management team's ability to identify and execute such a deal. The appointment of independent directors like Jonathan Beer to key committees signals a commitment to good corporate governance, which is reassuring. What do you think about this IPO and the company's strategy? Do you see potential for a successful acquisition? Let us know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more. And don't forget to join our Discord community linked in the description. Thanks for watching, and we'll see you in the next Decode.